What's up, everyone? It's Greg, your host of the Opportunity Podcast. If you're watching this on the YouTube channel, well, hey, did you know we have a podcast? Go to empireflippers.com/podcast and you'll get to see a bunch of episodes where I interview a wide variety of entrepreneurs from all walks of life, business buyers, business sellers, and people just building really cool startups. Now, if you're listening to this on the podcast and you don't know what I'm talking about, we have a YouTube channel at youtube.com/empireflippers where it's just me ranting all the time about different concepts when it comes to M&A. So definitely go subscribe over there, click the links in the YouTube description box where you can click join up with our marketplace for free and buy a business or maybe sell a business to help Greg's marketing KPIs. So thank you for that. Now, I've been doing these solo podcasts because we had a rash of basically guest rescheduling on me. And so we're getting a little bit behind. I thought, hey, good opportunity for me to get on my soapbox. In this episode, we are going to be talking about how you can buy a business with none of your own money or less of your own money. Now, I like to do this video because I see this often where someone will watch some business buying guru in the content creation space talk about these $0 down deals, no money down deals. Like I bought this business for $1. And it's interesting to me because I helped sell over 24 businesses with our team here at Empire Flippers. 90 sellers, a millionaire at the moment of exit. And we have built a buyer network of over $14 billion, I think, at this point. So I have a pretty interesting perspective, I think, because a lot of these gurus will also say you should never use a broker, but that's completely false. You should definitely use a broker and do private deal flow. But I wanted to talk about this concept of using not your money to buy the deal, because when it comes to buying a business, part of your criteria is going to be your budget. How much money do you have to go and acquire a business? And if you're like most business buyers, if people want to buy a business, this is usually the biggest roadblock. Like, I don't have money to go and do a deal. But just like in real estate, you don't actually need that much money and sometimes any money to go buy a deal as long as you understand a few key concepts. So let's break this down into basically two buckets. Now, by the end of this video, I'm not telling you you can go buy a $0 down deal. Although those are real, like the gurus are not lying, they do actually exist. In fact, we have done, I think, at least one where the buyer put none of his own money into the deal. This is more advanced. So if you are brand new, like a lot of gurus, when they're talking about this, it sounds very sexy. It's very appealing. I don't have to use any of my own money. But just keep in mind, if you're brand new, this is going to be hard for you to do because this is an advanced skill set. This is an advanced kind of like deal structuring type of stuff. But it's okay. I will give you some newbie friendly ways where you can use less of your own money to get into a deal. And then you can work your way up in terms of your own skill level to eventually be like one of these famous gurus who are doing all these $1 down deals, right? So the first thing to keep in mind is when it comes to the budget of buying a business, we basically have two main buckets we're operating from. And I call this YPM and OPM. So YPM is your personal money. That's money that's actually in your checking account, in your savings account, or somewhere you have access to it. You have liquidity. That this is your own liquidity. If you have only $100,000, then your YPM is $100,000, right? That's the maximum amount that you could use to go and buy a business. And you might be thinking like, well, if I only have $100,000, that means I can only buy a business up to $100,000, which I don't actually recommend you to do. Like I always say, you should only put money into acquiring a business that you can afford to lose. Like if you're okay with losing all the 100 grand, then, fine, more power to you. Right. But I always like to be more conservative here. And YPM is where most newbie business buyers, their whole buying a business journey gets killed because they can't think creatively about how can I go about this even when I don't have that kind of money. Now, my father, he was a real estate agent and real estate investor and an old oil field guy, similar to me. But when he got started in real estate, he also had no money and the interest rates were skyrocketing in the 70s and 80s, especially in Alaska, where we're from. And he was able to still get a lot of properties because he just thought creatively. He figured out like, okay, well, if I don't have the money, how can I go get the money? How can I give the seller what they want, right? And the same holds true with M&A when it comes to buying a business. In fact, I think there's even more room for creativity with buying a business than there is in buying real estate. So let's talk about the other bucket, which is a much bigger bucket. There's like entire books written about individual segments of this other bucket I'm about to talk about. But you have your YPM, your personal money, and then you have OPM, other people's money. And OPM is how most business buyers, at least if they're prolific, can go and buy, say, a business every single month, which during the peak of the business buying boom, in a lot of ways, we had buyers doing stuff like that. So how could they do it? It's not like they were these princes or like an heirs to an oil company or something, right? So how were they able to do it? Well, they did it with OPM, other people's money. Now, other people's money comes down into multiple subcategories. The two big categories that pretty much all the other subcategories rest underneath is going to be raising an equity check. So we'll get into what that is in a second. So raising an equity check, and then also debt. So you hear debt, you're like, oh, spooky, debt. But debt is actually extremely powerful. And I will talk about that here in a second. But let's talk about raising the equity check. So when you hear a business buyer talking about raising for an equity check or trying to get an equity check, that means usually they're putting very little, maybe none of their own money into the down payment of the business. So let's say it's $1 million business, the equity check that's required to use the other aspects of OPM is probably going to be about 20%. So $200,000, but they don't want to put their own money into the deal. So what they do is go and raise that equity check, that 200 grand. So they're basically promising 20% equity or something like that to whoever gives them, and it could be several people that give them the 200 grand to go and buy this business. So they're talking to investors. Usually these investors are other entrepreneurs at this level, though sometimes it could be a family office or private equity, something like that, right? To go and acquire these businesses. And they use that money, once they secure that equity check, to go secure the other side, which is the debt stack. The most common route would be like an SBA loan. They go and get an SBA loan, which goes up to $5 million. So in this case, they sell a little bit less than 20% equity in the business, get that $200,000 equity check, and then they go and take out an $800,000 loan from the SBA program. So that's it in a nutshell. That's OPM in a nutshell, right? And in that scenario, which these kind of scenarios happen, I wouldn't say every day, but often enough, I wouldn't call them super uncommon. Like this is a zero down deal. Like you put no money into that deal, right? You use zero your own YPM in this example, you using pure OPM. So that is like the two main categories here, right? Now, when it comes to the debt stack, I think it's important for us to talk about this a bit because people have like uncomfortable feelings with the word debt. Some people is like, oh my God, this is a curse word in this household, like credit card debt, student loans, like bad juju, right? But when it comes to buying a business, debt is awesome. Like debt is way better than the equity check. Like in that example I just gave where the person raises 200 grand, like if you have the ability to put it all in debt, I would 100% put it on debt. That's like way better in my mind. A lot of entrepreneurs and people in general, you have a very negative relationship with debt. But if you want to be a serious business buyer where you are like really growing at lightning speed, debt is one of the most powerful tools out there. And it's much cheaper than the equity check. I'll give you an example. So let's say that $1 million deal, right? Let's say you put that 200 grand from the equity raise. So you've given like, say, I don't know, 19% equity to your investors. And then you have $800,000 in debt that you're paying over 10 years. Let's say that business gets to, I don't know, over the 10 years, you can exit it for $8 million. Or let's say $10 million for easy math. So in this case, you are now paying your investors $2 million for that exit. But your actual debt, your cost, where you owe that $800,000 over 10 years, when it comes to interest and all that stuff, you're probably looking at like, 1.3, 1.5 million, probably less. I'm bad with math. But when you look at all the interest that you're paying on that, it's significantly less than the equity that you're giving to these investors, right? And unlike the investors, this debt builds a track record for you where it can open you up to other forms of your debt stack, like lines of corporate credit, HELOCs, all sorts of good stuff that can come from this debt stack, right? So when you actually pay way less with debt than you do typically with equity. A buddy of mine who works in private capital, he told me, if you take out $100,000 loan and you can't make 25 grand on that, then one, maybe you shouldn't be in business because that's not great. Like that's an aggressive interest rate, right? That's 25% in that example, which most interest rates are lower than that. But he makes a very good point. Like if 25% interest rates scare you, then raising equity should really scare you because they're expecting a lot more than a 25%. Like they want way more, right? But the reason why this fear happens, at least in my view, is because the risk isn't front loaded when you raise equity. Like it feels safer, even though you're actually getting taken for a much bigger ride in the long term than debt. And debt can feel a lot less safe because, especially if you're not using private capital, you most likely will have a personal guarantee, a BG, which means like if you don't pay your loan, they come after everything you own, right? Which if you use private capital, there's ways to do loans without PGs, but this personal guarantee loan often scares people to death. Like, oh, they're going to take everything. And like, depending on where you are, like that might not even be a big deal, right? Like if you're just renting an apartment and you have like no assets or whatever, like, okay, what are they going to take? Right? Like for you to get a shot at buying a $5 million business seems like a pretty good exchange, right? So it's always based on context. So OPM is extremely powerful. And the crazy thing is, the bigger the business you buy, the less YPM you'll use, and you have more opportunities to use zero YPM the bigger the business you buy, because bigger, higher quality businesses are rare, and investors that do offer these equity checks, they are hungry for that. They want to find a really, really good deal. So if you're able to find a really, really good deal, whether it's through Empire Flippers or your private stuff or whatever, and you're able to bring them that deal, then there's a higher chance they can give you that equity check, right? So that's the basics of how do you buy a business with less of your own money. You have YPM, you have OPM. OPM is a massive bucket with tons of stuff that includes the equity check raise and debt stack. Now, let me talk to you about a way you can go and buy a business with less of your own money without having to do any debt, without having to do any of the equity raise. Now, in this scenario, you most likely will be using YPM, but this is very newbie friendly. So when it comes to buying a business, the two most common ways to use less of your own money when you're going to buy a business is in the deal structure. And those two ways are seller financing and earnouts. So let's explain these because they're kind of similar. They're cousins to each other, but they have kind of different purposes. So a seller financing is where the seller acts like the bank. So in a $1 million deal, maybe you put 200 grand of YPM into it, and the seller finances $800,000 over a period of a few years. Now that's a pretty aggressive seller financing. I have seen it go that high though. I think I've seen about 70% of a deal seller finance from EF, which is I think the most we've ever done. But more typical ranges are going to be like 30%. I have some buyers, they will only do a deal if the seller will at least finance 20% of the deal. Now you might be wondering, well, why would a seller do this? And the reason why is because financing can be tough to get. OPM isn't exactly easy. Like the gurus make it sound easy, but it's not. Now for them, it actually has probably become easy because they have a track record, they have connections, all that kind of stuff. But if you're just starting out, it's not easy. Like your hardest deal in M&A is almost always your first deal because you just don't know what you don't know, and you don't know the right people yet. You're still learning, right? That's what makes it so hard to get across this hump, especially if you're trying to do all this creative deal financing, which is pretty advanced. So with seller financing, usually what you're going to be looking at, like a more realistic take, is 20 to 40% of the deal. So in a $1 million deal, you can look at the seller finance of $200,000 to $400,000. So great. We went from you having to pay $1 million to now you paying between $400,000 to $600,000, something like that, right? Because you'll put the $200,000 down and then get 200,000 to 400,000 in seller financing. So that's seller financing, and with most businesses, with brick and mortar especially, usually the seller is going to charge you an interest rate, and that might be comparable to what the bank charges. It might be less. It really is a handshake deal. One interesting quirk: if you're buying digital businesses like what we sell, I'm sure there's been one, but I can't, like the vast majority of businesses, so over 2,400 businesses we've now sold, I can only think of, well, actually, I can't think of a specific one, but I don't think we've ever really had sellers charge an interest rate to our buyers. So that's a quirk of digital businesses in general. Like usually it's just like free money, right? Like, so you might get $300,000 in seller financing with 0% interest. Like, why would you ever say no to that, right? So seller financing, extremely powerful. And since it's a handshake deal, I mean, it's written in the contract, but a handshake deal in terms of like institutional level, these are very quick ways to put less YPM into a deal. Now, the other one, the cousin to seller finance, is earnouts. Earnouts work pretty much the exact same way as seller finance in the sense that the seller is financing that portion, but it's called an earnout because the seller has the ability to sometimes make more money than if they just did straight seller financing. Also, this is a tool that is used a lot of times improperly, but the way it's supposed to be used is, let's say that $1 million deal you're looking at, you think it's worth 800,000, the seller is convinced it's a million, you negotiate them down to 950, like, hey, we have a $150,000 gap. So what you might do is like, okay, let's do an earnout. Like, we'll do the seller finance portion as if I bought it for $800,000. So you'll give me the $600,000. I'll give you $200,000. But then we'll also do an earnout of $150,000 over this X period of time that I will pay you if the business hits this goal. So earnouts are always tied to some kind of key metric, some kind of milestone that is very black and white. It hit it or it didn't hit it. Usually it's going to be tied to revenue. So you buy a business that is making $50,000 a month in revenue. Maybe the earnout is like, as long as the business makes $40,000 and up every single month for the next 12 months on average, then you qualify for your earnout payment, right? Something like that. And what this does is it helps bridge you and the seller on the valuation gap. The seller thinks their business is worth a lot more. You say, okay, great, I will pay you a lot more as long as the business does X, Y, Z. So it helps you mitigate risk while also coming to a compromise with that seller. So in this case, you buy it for 950K, you put 200 grand down, they give you $600,000 in seller financing and $150,000 in earnout, which this is a very aggressive deal structure, by the way. I have seen deal structures like this before. Usually sellers won't do this much. but in this case, in this scenario, you are effectively using the seller as your OPM, right? And you are helping protect your own downside because the earnout helps protect you. Like if that business falls underneath that $40,000 a month in revenue, you don't pay the earnout, right? So it protects you from losing out on that 150K. Now, these are the two most common ways to use OPM when it comes to buying a business. One of the big mistakes, or I shouldn't say a mistake, but maybe a misconception that keeps newbie buyers, such as maybe yourself, from ever buying a business is thinking you can only use one of these at a single time. So with seller financing, you can get between 20 to 60% of a deal finance. Like I said, I've seen it up to 70%. And there are certain scenarios, I've never seen it with EF, but I definitely know they exist, where you do like 90% or even 100% seller financing. Those are very rare. Don't don't try to do that when you're coming out of the gate as a newbie, because usually there's problems with businesses where the seller does that. But it's very reasonable to get 20 to 40% in seller financing and even 50% in seller financing. So this is an extremely powerful tool for you. Now with earnouts, it's usually going to be between like 10 to 30%. And if you're using both, you're probably going to be on the lower side of these ratios, right? Because the seller wants to get paid something up front. Now, the mistake that people make is you can use more traditional OPM, such as debt stacks, with seller financing earnouts. So you can go and get say a commercial bank loan. That you do this with SBA, but there's plenty of other debt products out there where you can go and like, hey, I'm putting 200K into this 950K deal. They're giving me, let's say it's 200K in seller financing. So we're at 400K. We need $550,000 left. They're going to do $150,000 in earnout. Okay, so now we need, what is that, $400,000? So you go get a $400,000 commercial loan on top of the seller financing and the earnout. So that's how you can mix and match all this debt stack. Now, there's a bunch of smaller debt vehicles you could use too, such as vendor financing, revenue-based financing. There's a bunch of stuff out there. You could even do accounts receivable financing. There's a bunch of stuff out there you can do. But these are the basic tools. Like when you're looking at buying a business, how much money can I put down? That's your YPM, though it doesn't have to be YPM. And then what is my OPM going to look like? What kind of deal structure can I make? And the secret to buying a lot of businesses fast and using less of your YPM is really mastering deal structuring, the basics of deal structuring, which is usually seller financing and earnouts. Those are your two most powerful tools. And then learning all the nuances to the other aspects of OPM, whether it's raising equity checks from affluent entrepreneurs or learning how debt works in terms of both the commercial side of debt, but also the more creative side of debt. So with debt, you have like traditional banks that most people think about, and that can be often the best, but also sometimes the hardest type of loans to get. But you also have a bunch of niche financing products, such as, again, there's vendor financing, right? But then you also have things like private capital that if you're buying a big enough business, they will sometimes come in and give you that loan and there's no PG. But like private capital markets are fantastic. But this is, again, advanced. For you as a basic business buyer, like someone just getting started, what you should really be focused on is seller financing and earnout and how to structure those two things, and then figure out the YPM. Now, again, for some perspective, most seller financing and earnout stuff, like the opportunity to even do that, starts at businesses valued at $500,000 and up. If you are buying a business that's less than $500,000, especially less than $200,000, and you're trying to do a seller finance or earnout thing, not saying you can't do it. You absolutely can. We have done it. It's just that you have a higher chance of being beaten out by an all cash buyer. And that's okay, right? Like that's completely, it doesn't mean you shouldn't try. You should always try, like especially seller finance when it comes to internet businesses, like 0% interest. That's fantastic, right? Like you should always be asking for that. I mean, the worst thing they can say is no, and then you just buy the business, right, with your YPM. But that's my advice for you. Like you can go and buy a lot more than you think you can right now. Like with an SBA loan, say your YPM is $100,000, you only need $50,000 to buy $1 million business using a traditional SBA loan, as long as you get the seller to carry, I think it's 5% that they're allowed to carry, which means your down payment only needs to be 5%. And then the SBA finances the other 90%. Like there's a ton of ways for you to go out there and be creative and go and do these deals. Now, one last thing to end this little rant of mine is I was talking to a guy, this is about, I don't know, 2 years ago, and he's an engineer in France, and he had watched a bunch of these guru videos talking about $0 deals, right? And so him and I started talking. We had a pretty good call, and he had no experience with e-commerce. He had no experience with digital businesses. I started asking him more what he does. I think he was an engineer in like aerospace or something like that. And I told him, like, dude, like, I think you should just go and start an aerospace consulting business because, like, you don't know anything about e-commerce. It doesn't sound like you're curious about e-commerce. Like, it sounds like you're really into deal making, which is great. Like, you can go do deal making in the aerospace niche. Like, you should follow what you know, was the first thing. But the second thing I told him is the thing that these gurus are not telling you, even though they'll, like, if they're honest, they'll 100% will tell you because in their view, they think it should be obvious, is the more debt you put onto a business, the more of this debt stack you put on the business, the more fragile the business becomes. So in the case of the 5% down SBA loan, right? Yes, you're putting on very little amount of money to get that business, but you are also shrinking the margin of failure you have. And what I mean by that is because so much of your money is going to service the debt, that means if something goes wrong with the business, you don't have a lot of room to maneuver. You don't have a lot of margin for error, right? You got to be pretty good. Now, the best business buyers I know, they do insane leverage, like 1% down with crazy debt service payments. Like they're probably having like 80% of the cash flow or 90% of the cash flow go to service their debt. But it works for them because they understand growth really, really well. They understand how to grow a business really, really fast. Now, if you are brand new as a business buyer, I think that is a very dangerous move. You shouldn't be doing that because you don't know what you don't know yet. So, my advice for you, whenever you're using OPM, especially if you have debt service of some kind, you should never do more than 50% of the cash flow. So, if you're buying a business that makes $30,000 profit per month, your debt service should never exceed that $15,000 a month mark of what you have to pay back. Now, the reason why I do that, like you'll probably end up putting more OPM into a deal like that, but you also save yourself if there is a storm that happens with that company where, say, profit falls by like, from $30,000 a month to $20,000 a month. Like in that case, like you still have the 15 grand to pay the debt and you still have 5 grand a month to try to like figure out how do you fix this, right? This is what I mean, the margin of error. Every time you add more debt to your debt stack, the less margin of error you have. And as you get more skilled, that's okay. Like it doesn't matter because you understand how to grow the business really, really fast. And depending on how you do the debt, even if the business fails, it doesn't matter because as you get better and better at this and you build a better track record, you will most likely eventually migrate away from having to do personal guarantee loans as you move into more private capital markets, which they love people with a track record there. It becomes easier once you have a few deals underneath your belt, right? So keep that in mind. If you're just starting out, focus on seller financing, focus on earnout, and figure out like get good on negotiations to lower what the seller wants as well. And you can mix in some PG, especially if you're just starting off your career where like a PG doesn't really matter, like whatever, right? But down the road, like this becomes much easier, and you can become skilled like those content creators where they're doing all these like no money out of pocket deals are super highly leveraged. But I only recommend you do that once you know how to really grow the business. Now, I want to end this with one final thing, which is something that the gurus often say. Like they'd say, don't use a business broker because you're just paying a premium for their commission. And that's not completely false. They're not wrong, because that's how we get paid, right? At Empire Flippers, we get paid when someone buys a business from us. The seller pays us a commission for helping them sell it, right? That's how our whole business works, right? So they're not wrong that you probably will be overpaying a little bit when it comes to using a broker. But again, if you're brand new to buying a business, that's okay. In fact, the best business buyers I know, they use brokers all the time. So these gurus say, oh, you should only do private deal flow because that's where the best deals are. Yeah, that's true. The best deals are private typically, but the best business buyers are using private deal flow and brokers at the same time. They view us as like a marketing channel, right? Just like you would view cold email and meta ads as two different marketing channels, they view us as a marketing channel. They have their off market channels and then they have their on market channels, which on market is the brokers that they have relationships with, right? So when they say this to you, don't use a broker, and you're brand new, and they're telling you to do these like crazy leverage deals, this is setting yourself up for massive failure in my mind, because there's just too much going on and you don't know enough yet. You're just getting started. It's like telling someone like, hey, go do this marathon and you just learned how to walk last week. Like, that's not setting yourself up for success. You got to build your way up to it. And brokers, as long as they're good, reputable brokers, can teach you a whole lot about buying a business for free. Now, let's talk about the premium part. Like, well, I don't want to spend the extra 10% that I might have to pay with a broker, which usually is not even that much. But let's say you do pay the extra 10%. This isn't like real estate. Like in real estate, you make most of your money based on how you buy the house, buy the property, right? So it's very, very important when you're buying real estate to make sure you buy correctly, because that's going to filter throughout the entire deal for the rest of that life of that deal until you refinance or something, right? Buying a business is a lot more forgiving than that. If you buy a business where you pay 10% over what you should have paid, yeah, that sucks. You could have saved some money, right? But unlike with real estate, you can massively outgrow that premium. You can't do that with real estate. Like if you buy a rental and it's making $500 a month in profit from the rent, you can't just next month make $1,000 a month. Like, I guess there's probably ways to do it, but it'd probably be really shady and probably unethical would be my guess, and illegal. But in general, you can't do that with a rental. With a business that's making $500 a month, it's very common that next month you can make it at $1,000 a month. I shouldn't say common because it takes skills, right? But it's very much realistic. It is probable, as long as you put your effort into it, that yeah, you can do it. Like I've talked about it on a lot of this solo podcast because I think it's an awesome story. The guy who bought a $180,000 Amazon FBA business from us. Did he overpay? Maybe, but now he's selling it with us 22 months later for a little bit over $1 million. So do you think he really would care if he overpaid? Probably not. He already is a millionaire from that purchase, even if he doesn't sell it with us, right? So this is what I mean. Buying a business is a lot more forgiving on the actual deal structure and the purchase, as long as you're being reasonable about it, right? Even if you overpay, because unlike with real estate and other investments, you actually have a lot more control to grow that investment in an explosive way. All right, there you go. There's my ramble. If you want to buy a business, and this is something that often you find yourself struggling with, just keep it simple. You don't have to do all these crazy advanced deals that you see the content creators talk about. In fact, I would recommend you don't do that, because you need to learn the skills first. Focus on your YPM so you can have that good down payment. Focus on learning negotiations and focus on using seller financing and earnouts. Those are your four main tool sets for your first business. And you don't need to knock it out of the park. You just need to do a pretty good deal to get the whole ball rolling. And remember, your first deal has all the mindset, fear, all that kind of stuff, right? Is almost always going to be your hardest deal. And as you build a track record of success, success breeds success. And soon you will have people wanting to give you money to go and acquire a business where you use none of your own money. Talk to you soon. There you have it. I hope you enjoyed it. I hope it got you inspired at all the different things that are happening in this industry.
And of course, if you just want to buy a highly profitable business, you can always go to empireflippers.com/marketplace. Or maybe you want to make an exit of your highly profitable business, and you could go to empireflippers.com/sell your site. I've been your host, Greg. If you enjoyed this episode, make sure you leave a review, give us a like, a follow, share it across social media. Talk to you all soon. See you on the next episode.